Hi, I'm Lisa Gonzales, Chief Business Officer here in Mount Diablo Unified. In this week's episode of Ask the CBO, we've got a special guest with us. His name is Greg Isom, and we've been working with him for a couple of years here in the district. He's the managing principal for Isom Advisors. He's located right here within our school district, and we're going to be talking about how bond refinancing benefits all of you taxpayers here in the Mount Diablo Unified School District. So, Greg, welcome.
Hey, excited to be here.
So this is a presentation that we had at the last school board meeting. It was just last week, but we wanted to make sure that we were getting this information out to the greater public. So we're just going to walk through a little bit of the presentation. I'm going to let Greg go ahead and take it away, and we'll see where we go.
Fantastic. Okay.
We'll go ahead and start here.
All right. So, how bond refinancings for school districts work, it's kind of similar to a home mortgage. When you refinance your home mortgage, which is, there's a set rate in place. And when you refinance your home, your interest payments go down, which in essence is your like your monthly mortgage payments. And it's kind of similar for school districts to where you have the ability to refinance old outstanding bond debt. But as opposed to, it dropping a considerable amount monthly per homeowner, it's spread out through all the taxpayers throughout the entire Mount Diablo Unified School District. The other benefit to when you refinance school bonds is that it doesn't, reset the term and go back to, let's say, a 30-year home mortgage. What you have the ability to do is refinance, and you can either keep the same time period that's existing on the debt already, or in some cases, you can actually shorten the term of that debt. What we talked about with the school board last week was just keeping the same term as it was, but just lowering the interest payments, which is going to save taxpayers money. And so, as you can see on this page here, we are actually refinancing a refinance from 10 years ago. So in 2002, the voters approved a school bond, and those bonds were sold in different tranches. And so in 2013, those bonds were refinanced, saved taxpayers a couple $1 million. And right now we're looking to refinance the remaining bonds, which I think go out for another 8 years or so. And by doing so, it's going to save the overall taxpayers $4.6 million. This is interest rate sensitive. So if we're able to refinance a week ago, but actually interest rates have continued to go down since that time when we made this presentation. So my expectation is that the savings could be a little bit higher than the 4.6 million. So Lisa, if you go to the next page, it'll kind of show where the old rates were, which are in that yellow kind of, line, mustard line, we'll say, compared to where the current rates are in that red line. And so you can kind of see in between there, that's how the savings are generated. So you can see that there is from 2023 to 2031, that's the remaining life of this bond. And that's how the savings are going to be generated. And so if you go to the next page.
Sorry, before we go to that next slide. So we're all hearing on a regular basis that the feds are increasing interest rates, right? And so interest rates keep going up, but you're talking about interest rates dropping. So can you talk a little bit of the difference between if you were refinancing a house and those amounts going up, as opposed to how this scenario is different?
Yeah, it's interesting. It's what's going on nationally. A month ago when we heard about Silicon Valley Bank, Credit Suisse, First Boston, all these banks were potentially collapsing, filing for bankruptcy. What happens is that investors who are looking to put their money in, to try to make money off of something, say, I don't want to put my money in the stock market right now because the stock market, the Dow Jones is dropping dramatically. So I would rather put my money in a safe investment. And one of the safest investments right now, and I should say not right now, but always, are California school district bonds. It's one of the safest investments that is known demand. So any investors that are listening to this, invest in California school district bonds. It's almost a guaranteed return on your investment. And so, as I said, people are saying, well, I don't want to invest in the stocks. I want to invest in California school bonds. And so supply and demand is going to make rates go down. And so that's how these opportunities exist for school districts refinance bonds, even when you hear that mortgage rates are kind of going up. Well, bond rates right now are kind of going down because right now California paper is in high demand, high demand. So that's why this opportunity exists.
Thank you. And I knew all that, but I knew that you could describe it and explain it better than I could. So tell us what this slide means.
I'm sure you could have done a better job than me, but I appreciate the compliment. So on this slide here on page 5, this just shows you how the savings are going to be realized. And when, as I said, for a bond refinancing like this, where we're saving $4.6 million to the overall tax base, this isn't going to, most taxpayers probably aren't even going to realize a difference on their tax bill. I mean, school bonds in general already, represents such a small percent of the overall tax bill, and a refunding of $4.6 million. Why $4.6 million is a great number. To the individual taxpayer, there's not going to be too much of a difference on here. So what the benefit is for this school bond refinancing is, one, you're lowering overall debt that the district has in regards to its bonds, which helps out with its credit rating and which just helps out in general. But also, I think it's an opportunity, and the school board kind of said this, which is, hey, if we have an opportunity to save our taxpayers a nickel, we're going to do it, right? And so you can see on this chart here from 2023 to 2031, that's how we get to the 4.6 million. So the individual homeowner, maybe they're going to save a quarter. But once again, as I explained at the board meeting, if you put a gigantic pot in the downtown Concord, everyone threw in their quarters, that's going to add up to this $4.6 million. Okay. So I think it's a win-win. I guess the district could do nothing. And these investors in New York and Chicago can keep your higher interest bonds. But as I said, the ability to refinance is always a good thing if it's going to save taxpayers money. And so that's where these savings are. And let's see, is there a following page? Yeah, on the following page is just kind of the timeline when it comes to, how close are we to locking in these rates? Because there's a little bit of a time period from when the district says, I want to save money, to when the savings are realized, or I should say when the interest rate is officially locked, right? So there's no variable rate. These are fixed rate bonds. And we are hoping to price these bonds in the next 10 days, 2 weeks, I should say, is what the goal is. And then, 2 weeks later is when the official deal is closed. And that's when the tax collector is going to have the new debt service repayment schedule. So all in all, I think this is a great time for the district to lock in some low rates for some of their higher rated bonds.
Excellent. And what those watching this don't know is that we are talking almost daily with the preparation that we have and the bond ratings. Like we just had our call yesterday with Moody's. And so there's actually work that we're doing here in the district on a daily, if not weekly basis right now to try to continue to move this forward. Even though we as a district, we don't see any advantage or any savings, we know that this is good for the taxpayers, which is why we're doing it. Yeah, no, correct. I mean, you guys, the admin team has been doing a great job so far. I'm not just prepping it because we're on video right now, but in general, when it comes to doing the rating presentation, we had to prep for it. We had the call with the analysts from Moody's. As I said, they were kind of agreeing that the district is going to be in a good position to maintain their strong AA credit rating, which is going to result in an even better interest rate savings to the taxpayers. So I think that's the bond refinancing. There you go. Well, hey, I just want to say again, it's great to be able to partner with you. I know that our district and our team really has a great relationship with you and your team, as well as the other folks that are supporting all this work. So I want to say thank you again. And if anybody's got any questions, please go ahead and send those to cbo@mdusd.org, and you may see your question and answers in a future Ask the CBO. We'll see you next week. Thank you. Bye.